Hello, and welcome to Electrifying Growth, a podcast brought to you by Edison Partners. I'm Chris Sugden, managing partner here at Edison and your host. There are moments in a person or company's journey that are undeniably electric. The spark or sparks, if you will, that propel you or your company to new heights. With Electrifying Growth, we're here to have in-depth, real conversations with great leaders who have been there and done it before. Edison has been investing in high-growth technology companies for more than 35 years, and I have been here at Edison doing this investing piece for more than 20 years. We've led over 225 investments. We understand that it takes great leaders and visionaries to build market leaders. We are your support system, a CEO and management's entourage, if you will. Let's introduce this episode's guest. We are thrilled to welcome and be joined by Mitch Caplan, a distinguished leader and innovator whose career spans over 3 decades in financial services and fintech. I've had some refer to me as someone who's been at the beginning of fintech. Mitch clearly is one of the godfathers or grandfathers, and I joke, Mitch, sorry about that, of fintech. Mitch is currently interim CEO of Yieldstreet and chairman of Tarsadia Family Office. His journey includes founding the first mobile or branchless bank, Telebanc, which he took public and eventually sold to E-Trade. He then served as CEO of E-Trade and CEO and founder of Jefferson National, a tech-first wealth advisory business. Throughout Mitch's career, he specialized in leveraging technology to redefine banking and online trading, as well as democratizing investments in wealth management. As a seasoned executive and advisor, Mitch combines his deep expertise in financial technology with a passion for building sustainable, scalable businesses. He has a proven track record of developing high-performing teams and crafting strategies that navigate complex industry shifts. In this episode, Mitch shares incredible and candid thoughts on leadership, the evolving landscape of fintech, many lessons learned along the way, including having lived through and scaled businesses in 3 or 4 major crises or changes in the landscape. Whether as a founder, an investor, aspiring entrepreneur, or someone just seeking valuable business insights, I think you're going to find Mitch to be an incredible guest here on Electrifying Growth. Mitch Caplan, how are you today?
I'm great, Mr. Sugden.
Thank you so much for joining Electrifying Growth. We've had a fun few years working together, and given your financial services and my financial services and fintech kind of background, it's amazing it took all the way to Yieldstreet for us to have intersected, which we'll talk about that journey in a little while. But I remember many years ago, an investment banker, we'll just say named Jane, and said, you and Mitch need to talk, but for whatever reason, we never made it happen. But having worked with you the last few years and knowing how much experience you have, I'd love for the audience to hear kind of in your words, they heard your bio in the opening. Take us back.
Cool. Happy to do it. So I did graduate school, both business school and law school. Unusually so, I did them sequentially, right? So I did the 2 years of business school and 3 years of law school because when I came out of undergrad, I knew absolutely not one thing about finance. I didn't know what a debit or a credit was. I didn't know how to look at a balance sheet or an income statement. And so the idea was at least get schooled in the basics of finance. So off I went to law school and I practiced for about 5 years at a firm in New York, Sherman and Sterling, doing a lot of corporate law. And I knew enough that I wanted to get schooled at really thinking through deal construction, deal dynamics, negotiation, all of that stuff. And I also knew quite early on that I had zero interest in becoming a partner at a big law firm, that I really ultimately had sort of what you would think of as the entrepreneurial bent to start something. So once I got through 5 years of practice and I knew I had learned basically enough to be dangerous and to move on and really try to start something, I'd been introduced to a close friend over the years, and he was at Goldman Sachs, and he was trading mortgages for a living on their proprietary mortgage desk. A funny story with John Thain, who I then got to know when he was running the New York Stock Exchange. And we said, you can appreciate this better than anybody. We were like, okay, what do we want to do? We want to manage assets and generate a really interesting return for our investors. And the way to do that in those days was to get your hands on assets that were owned by the Resolution Trust Company from all the failed savings and loans. How did you do that? You had to have a bank. So off we went to buy a bank. You're talking about sort of the 89-90 time frame, yep. 1989, 1990. We thought it was a really interesting avenue to manage assets. And candidly, you can appreciate this. We didn't want to start a business that was in the fund management business because if you had a lousy quarter, everybody pulls their capital and you're sort of, then now what do you do? So we pitched friends and family. There was really no venture then, right? So we pitched friends and family to raise $10 million to buy this bank, 5 million to actually acquire it, and 5 million for growth capital. Little tiny bank in the DC area, 50 million in assets, 30 million in deposits. And we ultimately convinced the regulators to let us do it. I think it was a bank, candidly, Chris, that was in trouble, not because of credit risk, but because of interest rate risk and mismanaging duration of asset and liabilities. And we thought, okay, we have an interesting way we think we have a way to fix that. And it lets us start buying RTC property, which we think we can buy. The crazy journey that I went on was in a very short period of time. The regulators said, we're not quibbling with you at all about the safety and soundness of your assets, but you can't run a closed-end bond fund as a regulated bank. You need to have depositors. And it was like, whoops, we hadn't really thought about that process. And
Wow.
what you learn in DC is it's really rough to have a subscale local bank because your cost of real estate is really high and expensive. And your cost of interest expense is quite high because you have a transient population. So you pay up in interest expense to get them
accounts.
to move accounts.
Yeah.
Yeah. So the margins are getting
There's a reason all these
squeezed.
little tiny banks are in places that people haven't heard of.
Totally. Precisely. And so it was like, okay, what do we do? I thought about branching rurally in like Loudoun County, Virginia, or Prince George's. And it was just like, I can't do this. And so we stepped back and we built a business plan, which the regulators basically had to support. And their rousing endorsement was, you will undoubtedly fail, but you have enough capital and your board's in charge of making strategic decisions. So we became the first branchless bank in the US. And we ultimately started selling on the premise of, would you rather have rate or real estate? And what we can give you is a rate that parallels or is better than a money market fund, and FDIC insurance is sort of a free option for you. And in exchange for that, you don't have branches on every corner and you deal with us remotely, hence the name Telebanc, because the internet didn't exist.
What's funny about this is, again, 35 years ago, a branchless bank was like, what? How's that going to be possible?
Exactly.
Today,
it's the way that right, exactly. Right. And so, I mean, you and I are living it now. We're going to get to it on Yieldstreet and like watching the evolution of what's happening in private markets in the same way that I watched it evolve with banking and with brokerage and online investing. But, honestly, candidly, we were at the right place at the right time. We had a great team. We focused on disciplined execution. And over 10 years, we took the business from the 50 million to about 8 billion in AUM. We became the largest first branchless bank. And then in the mid 90s, we morphed into being a true internet bank. And we became the largest internet bank, took the business public, and it was extremely profitable. And we went from basically being, you're going to fail, to being sort of an interesting story for the regulators to tell about, here's a way to evolve businesses that can be interesting in your ecosystem. And so it was great. It was really rewarding. Another great anecdote is at the mid 90s, we're all sitting around the table because you want me to set the context of timing. The internet is evolving, and you remember this. There are two models. You either say it's your bank software and you mail it off to a customer and they load it onto their computer.
like an AOL CD.
100%, right? And the other was this big open world of the broad-based internet. And we sat around as a leadership team and we went in circles for 2 days on which way should we go. And finally, everybody looked at me and it was like, what the hell? Like this open architecture internet thing seems like it might actually catch on. And so that's what we bet on. And obviously,
you're ahead of your time, Mitch. You're ahead of your time.
Well, there were moments I think I questioned that, but
right.
Nonetheless, it was great. At the end of 10 years, we were public. We had a currency. I was actually, honestly, Chris, thinking more about being an acquirer rather than being the acquired. But I knew that Telebanc would be so much more successful if it were embedded in a large asset gatherer, which really meant a broker-dealer. And we went about a couple of discussions in partnership. And ultimately, at the time, the guy who was the CEO of E-Trade, Christos Katsakos, I was in California, lore but true. We were at a Japanese restaurant having sushi, just the two of us. He looked at me and said, you know what? I think a partnership's a great idea. I think melding banking and brokerage is the future of the world. That said, partnerships really, really work. What he said to me is, this should be a merger. And I was like, I hear you. This is not a merger. Your market cap is 10x mine. This is an acquisition. I literally said, okay. I just couldn't believe the words came out of my mouth. I went back to the hotel. It was like whatever time it was, 10 o'clock at night, which was like 1 a.m. I called home. My wife answered the phone. She said, it's 1 o'clock in the morning. What the hell's going on? I was like, I think I just sold the company.
All right. So, because there's so much interesting stuff in there, and the E-Trade journey itself can be a 30-minute discussion, but I do want to talk about it. How did you and Christos even meet?
So ultimately, you know this, you'll remember this time. Sort of, it was the internet hype, the internet bubble, and everything was about partnerships.
Yep.
And so if you wanted your stock price to grow, you announced another really interesting, right? So we were partnering with people like Yahoo for distribution. We were partnering with people like Caplan. And ultimately, the idea, as I said, was integrating with somebody who was a true asset gatherer.
Yep.
And so I went and spoke to Schwab and Fidelity, I mean, to all of them. I knew most of them, right? But ultimately, I think probably at the time, it felt like where E-Trade was on its journey of growth, that it was just, I just felt like there's an easier to integrate. You know this, you live this all the time. Mergers are hard, integrations are tough. But my gut was it might be an easier integration with E-Trade, and parts of it were, and parts of it were quite hard. But honestly, it's a gut reaction. I basically said, I think this is the right thing to evolve the bank into where it really needs to become.
So I'll fast forward the story because obviously the merger or the acquisition, however it happens.
Yes, actually.
But a few years later, the financial crisis happens and lots of scrambling went on. I'm not sure how you'll tell this story, but I would say, voila, you become CEO of the whole darn thing.
I did.
So you can tell me, tell the audience how you want to tell that story, but that's a pretty interesting thing to go from the acquired to the CEO.
It is. And honestly, what happened was the journey really began in earnest, and you, boy, can relate to this because we're living it real time at Yieldstreet, right? But what happened was the internet bubble was blowing. Fundamentally, as you lived it, capital went from cheap and abundant to basically unavailable. We were burning an excessive amount of cash. And I walked into the CEO's office, Christos's office, and said, listen, I can, and by the way, part of what also happened, talk about gutting your model, which thankfully we haven't had to live through at Yieldstreet. But at the end of the day, we were still 80% of our revenue then was still transactional in nature. And of the 80% in revenue, it was almost exclusively coming from trading volume.
Right.
Trading trades went from 350,000 a day, Chris, to 80,000.
Unbelievable.
And so
like almost overnight too, right? It was like very
over a month, 60 days, right? And so I walked into his office and I was like, listen, I can have the bank compensate for some of the revenue we're losing. I can't keep up with it fast enough. 1. 2, even if I do that, the only way we're going to survive this, because you can't assume capital is going to be available to us, is we have to cut literally $1 billion of costs out of this business. And he was like, okay, got it, yours. So I set about, with the team at cutting $1 billion. And I think you have schooled me on this often, correctly so, which is the first 700 was easy, right? Seriously easy, because you're just doing so many things haphazardly, and now you're creating discipline and structure and process, and the last couple hundred was rough, but we did it. And we aligned everybody around the view that we were building so much of a stronger business that when we came through the other side of this and revenue started to grow, we'd be dropping every dollar of revenue, 85 cents of it to the bottom line, and it would transform the business model. And when transactions came back and people started buying mutual funds and ETFs online, it happened, right? And then we were lucky enough to be in a place where we did 2 very significant acquisitions. We bought Harris Direct from Bank of Montreal, and we bought Brown from JP Morgan. And I took our revenue from $1 billion to $3 billion a year.
Were those deals, because I frankly forgot about those, although I was living it right there in the bill pay world for banks, were those banks just saying, I need to be out of this business, given how, or, because it was hard to make an online bank work. And I just don't remember for the audience to say.
Totally right. And so what's interesting is I think that you saw 2 things happening. One was there was a period of very rapid adoption of all things that were sort of considered internet distribution for financial services.
Yep.
And you saw lots of people enter in. So you ended up with lots of players. And by the time that was happening, you really had 5 or 6 really scaled players.
Yep.
So think about, E-Trade and Fidelity and Schwab and Ameritrade. You can go through the list, right? And those were sort of the key, what I would consider to be the tier 1 players in terms of size and scale.
Yes.
But you had others that looked like the ones we went to acquire. And for a long time, they didn't want to sell,
right,
because they believed that what was moving in their favor was scarcity value. And I think at the point at which they came to the conclusion, they may have top ticked valuation for scarcity. It was like, okay, we see integration and we see acquisition integration happening everywhere. We need to be part of this, or we could actually get left behind and just be a massively subscale player.
Yep.
And so, I had, rightly so as CEO, circled with everybody in the universe all the time, making it clear that we were always open to a discussion about M&A on both sides of the equation.
Sure.
And so I had built a good enough relationship with the CEO at BMO, and the same thing was true with Jamie at JPM and Jess Staley, who was then running that whole wealth business, such that we got put into the fray. The great news was with Bank of Montreal, they sort of said, okay, I was like, listen, all I asked for is a 5-day lead. Just give me 5 days to come back to you and close this deal before you put it out broadly to the market. And I will move heaven and earth. And we did.
Nice.
From the time I got the call till the time we announced it was 5 days.
That's
awesome.
We
did the deal. Yeah. JPM, not so lucky, right? It was a broad process. We had to win. We worked hard and leaned in, and we were able to actually get it done. And the combination of organic growth plus those two took us from $1 billion in revenue to $3 billion in revenue. And we went from years before basically burning to making a little bit of money to we were making about $1 billion a year.
So a fun side, a little bit of a sidetrack, but I think it's too much fun not to cover it, because today, when you go on X or TikTok, you see these AI talking babies that are all the rage, and really some funny ones for the audience if you haven't seen the Trump and Powell babies talking in the new Fed Reserve.
Wait till you see our new launch for Yieldstreet.
But I was going to say, Mitch and our current CMO, I believe, if I got the story right, at Yieldstreet, kind of had the responsibility for the original talking baby.
We did.
And tell me, talk a little bit about that, because I think people today see the talking baby on E-Trade commercials and think it's new, but it goes back.
So this from living Yieldstreet together with me is truly my partner in doing this, that we have evolved the business in a much more disciplined way as we sit here today. And Leah, what I love about Leah is our CMO, and it was true when she was at E-Trade under the first CMO, Nick Hutton, and ultimately as the CMO. One of the 2 nice qualities they had is they were the cheapest people I've ever known in marketing and absolutely demanded value for every dollar they were spending. And the other is, unlike many marketers, they're the most data-driven people I've ever met. So every decision they made had to be supported by data, and they used data to course correct quickly. And the argument was always, there's nothing wrong with failing, just fail fast.
Yep.
Like the minute you try something, learn it. If it's working, double down. If it's not, course correct. And they used the data to be able to do that. Okay. So we became so much more disciplined in our marketing approach than in the early days of E-Trade. And one of the challenges, and this, is the early marketing at E-Trade won awards, but it was too irreverent. And so as I'm trying to get customers that look like middle to high-end mass affluent, they're going to go to a Fidelity or Schwab.
You're talking to a kind of almost too cool, hip audience.
Exactly. And remember the early days with the money coming out of your Wazoo ads and all that sort of, people laughed out loud, but it didn't allow us to have sort of the view that we were a serious place for financial wealth building. And so the idea was, how do we do a marketing campaign that breaks through all the clutter of all the nonsense you see in all these financial service ads, but yet it's not so irreverent that you can get people who identify who are really squarely mass affluent. And, we went through the debate over the next podcast, but we went through the debate over having sort of traditional spokespeople. And for a little while we had a monkey, and honestly, and when we had the monkey, we didn't understand that you had to really lock in a long-term contract. So the cost of the monkey between year 1 and year 2 went up like about 1,000%. And I was like, oh, the goddamn monkey.
Goodbye, monkey.
So seriously. So I was like, okay, guys, we're not going to be able to afford, or I'm not willing to spend to get any of these really highly expensive spokespeople. And I see it with some of our competitors, and I'm not sure it breaks through. So what can we do that is irreverent in the right kind of way to break through the clutter, still makes us feel relevant and warm and engaging?
Yep.
And ultimately, that was the mission. And they came back and said, we've created a spokesperson, which you don't have to pay for because we can substitute one baby for another. It feels warm and engaging. It tested really, really well when we tested it. And we did it. And it's iconic. I mean, even now, another anecdote for you is in my journey of being CEO at E-Trade, there was a period of time where James Gorman had been at Merrill Lynch. He called, reached out, wanted to make an introduction. Before the first meeting, his office called and canceled. Why? Because he was going on garden leave, because he was moving over to Morgan Stanley. Then he reached back out. He was always interested in E-Trade. And over time, we had this dance about acquisition. So when he finally acquired it a few years ago, I was one of the first texts saying, you got it, congrats, like you won it. But listen, they brought back the baby, right? Like when they said, we're going to lean in and start spending money, we think the baby still works. And
I think there's plenty of people who think the baby started just a little while ago. Do you know what I mean? That's
exactly. But to your point, that's right.
That's awesome. So I think about like RT Resolution Trust for those in the, again, young people who savings and loan crisis, thousands of what really weren't banks or savings and loans went out of business. Next comes what now is affectionately called the GFC, the Great Financial Crisis, right? Huge opportunity, but also crisis first. And again, you built Telebanc. Now you took over E-Trade and built it. And now here we are. I'm not so much Yieldstreet, but you'll get to that. What the learnings are from really now a third crisis, ZIRP, for those who love that term, they know it, but zero interest rate environment, if you will, the ZIRP environment where money's free, zero interest rates, unicorns being birthed every like 30 seconds, it seemed like, to almost what just happened, what you said happened with E-Trade, where money in the internet bubble bursting. It was like, so you had actually two things, right? You had the internet bubble and the GFC.
And the financial crisis.
But now here we are, it's really four. I did a bad job teeing that up. It's like the fourth thing you've seen in your career that kind of feels the same. As someone who's seen all of those, because I feel like I was way more junior, for better or worse, on the RTC one. So I feel like I've seen three of these.
That just means you're much younger than me.
That wasn't a dig. But I kind of feel like these always still surprise you. Like, I'm not, okay, third, for you, four, you still go, how's this happen so fast? Lessons from someone who's seen this in the front seat for, not to say predict doom and gloom, but what do you look back and go, these are telltale signs? You know what I mean?
Totally. So first of all, I think you've heard many people, Jamie Dimon among others, right, talk about, the tulip craze is a tulip craze, and it just happens more frequently than it used to. And it's going to keep happening. And I know you can appreciate this. One of the things I tell our team at our family office, which is theoretically my real day job, right, is, guys, when you're investing in businesses, what was it, 4 years ago, 5 years ago, everything was up and to the right. It was the same bubble you're describing. And what was happening was people were paying insane multiples for revenue. And I was the old guy and I didn't understand the new world order. And I would look at them and say, listen to me, you may be right. I may be right. The thing that you need to do is invest in a business that has strong unit economics and can build a powerful franchise. Because when multiples compress or collapse, and inevitably they will, you need to believe that you're in a business model that can grow its revenue and earnings so that you move back into the valuation you once aspired to, right? And that's, I've seen that cycle, to your point, at least 4 or 5 times. And, ultimately all you can do when you're looking to invest is to find something that you believe is in an interesting white space. So all the stuff you do and you school me on, right? How big is the marketing? How big is the market sizing? Is it growing? Is it shrinking? What's happening to that market sizing? Why do you believe you have a right to win within that market sizing? And then what are your unit economics once you start winning in a way in which you can build a compelling franchise? And if you have those three things, what may change is the duration of the hold, because you're going through macroeconomic crap that's getting thrown at you. But at least on a tactical micro basis, the business is solid. You just have to pivot based on what's happening macroeconomically. And we're going to keep going through them, right? We just do. Look, you and I are living it. There's a big course correction now on valuations for companies compared to what they were 4 years ago that sit in the fintech space.
And yet we're seeing, interestingly enough, fintech starting to see these like interesting little shoots, and you wonder, will it be premature? We're going to come back to that in a second. I want to know personally, first of all, we made jokes about both our ages, but your energy and desire to keep learning is awesome. And that's not just a patronizing statement. I've watched it and worked with you, but you also had to stay current, right? Like, how have you personally stayed, relevant's the wrong word, but current, so you feel like a technologist hanging out with younger people on your team as well as older people for all these decades? How's that worked for you?
So I'll give you two answers. One's slightly embarrassing, but actually quite effective. And the other makes me look sort of more thoughtful. The more embarrassing one, because it's just so relevant, is my kids will give me endless crap. Like, it's like, what do you mean you don't seen this?
You don't want to be the Luddite dad?
Exactly. I started getting the tutorials on AI for my children like 3 years ago. Like, they're like, this is the future. Like, why aren't you learning about this? And so, and ultimately, honestly, I do think both of us have it. I see it in you. We have a quest for learning and a thirst for knowledge, right? And we're always trying to take that knowledge in a way and assimilate it so it can be contextualized, and then you can use it to create something of value. And so I think, the minute you stop learning, you might as well be dead. So for me, it's just, and I know what I don't know. And so as much as we joke, the older you get, the more comfortable you get saying, I don't know, right? Like when I was 30 and building Telebanc, I would have never said, I don't know. I would have just shot my way through it.
At the same time, you have this amazing amount of knowledge, and you're sitting around a current team at Tarsadia, your family office, at Yieldstreet. You're advising other companies you've invested in. Maybe you now talk to the board members who might be listening to this, those who have more or less board experience than others. How have you been able to convey all that knowledge and not be from the I told you so, or the just trust me because I'm the old guy at the table? Because I find myself saying, this is going to happen. We've seen it before. And yet people don't want to believe that. Just trust me.
No, they don't. Listen, I found the most important skill for just in general in business is communication, right? I think you're an extraordinary communicator. I see it at our board meetings. I see it when you talk to other companies. I think I'm pretty good at it. And what goes with being a good communicator is the ability to contextualize. So, if I can say, I don't understand that, I need you to explain it to me so it makes sense on a contextual basis, or I've learned it and I then am pushing it back out. It's not do it because I say so. It's because it feels to me, this is where we are and this is what I've assimilated from everybody. And here's a logical conclusion of what we should do as a result of that. And I think that when you don't mandate, but you actually engage in discourse, but you're always stopping to give from your own perspective how that fits in from a contextual perspective, it's much easier to get buy-in.
Your boardroom, whether it's as a board member or chairperson or at the CEO seat, you're a consensus builder is what you're really describing yourself as, not so much a benevolent dictator, but a consensus builder.
Yeah, I think I am. And I think you see it. Like,
I do. You actually go out of your way. Your patience is much higher than mine. That's one of the things I try to learn from you, frankly, and I'm bad at it. So that's why these podcasts are also personal, because I get to learn from people like you. To be honest, your learning one hits a nerve because I do.
Yeah, but I'd say we're a good balancing act because you helped me cut through the bullshit.
So let's talk a bit about Yieldstreet. It's been we've had this fun, interesting journey because the financial services sector, without going through any of we'll call it more of the down, but everybody did. I mean, I've interviewed Dee from Moneyline. Now you've got the Chimes of the world and the Circles up and to the right. SoFi, was good, then it was bad, then it's good. In terms of the fintech cycle we've all gone through, and Yieldstreet's no exception. But you've remained a steadfast, and frankly, I know we at S have as well, without getting into financing and financial stuff. But Why the thesis? What do you believe in about, and why, how have you convinced yourself it's true, so to speak?
Okay, so let me give you, me in stories. Everything's a story. So 4 or 5 years ago, I got a call from a banker who was at Raymond James. You and I both know him, Brendan, well.
Yep.
And after E-Trade, I actually, crazily enough, started yet again another company. That time I mercifully kept it private, grew it over 7 or 8 years, and then sold it to Nationwide. And I hired Brendan as the banker to help me sell. So I get a call from Brendan a couple years later saying, hey, we're raising money for this company. You've talked to me in the past about democratization of private market assets. You talked about why you thought about it, but didn't execute on it at E-Trade in terms of both the customer base and the timing, right? I think this is an interesting time. I think you're going to get this in 50 seconds. Take the meeting. And I was like, okay, well, actually, my first reaction was I've looked at a bunch of these and I've passed because I don't believe in a single asset solution. And
it's almost like credit card days of monoline, right?
Exactly. Yeah. And I was like, and by the way, I think you can relate to this because you and I have debated this. When you're an investor today and you look at stuff, it used to be, was it a product or a franchise? Today, one of the questions, is it an app? Is it a product or is it a franchise? Like, where is it along that journey? And so he was like, it's a multi-asset class platform. I think you're going to get it. And so I got on the phone the next day with Melinda, one of the founders, who you obviously know well. And, we spent, it was 45 minutes or whatever that was booked with Raymond James. And I said to Melinda, this is interesting. This is my style. If you're interested in my money, you will be on the phone tomorrow and you will book 3 hours. And we are going to go through a colonoscopy tomorrow because I know enough to be dangerous here to really lean in and start getting to the heart of this. And honestly, he did a great job. And I very much believed conceptually, which is where you are and what you are getting at, that if you think about financial services, almost every product and service and solution gets commoditized and becomes fungible.
Right.
It just does. That's the evolution. Pricing goes down, adoption goes up, the adoption curve gets dramatic. I mean, you've seen that story over and over. I saw it in banking, I saw it in brokerage, I saw it in investing. I mean, and so, what are the bastions that hold out? The things that are opaque, right? So if you think about lots of insurance products, they still hold out as being quite expensive and not yet really fungible and commoditized. Term is, other forms of insurance are not. Why? Because they're confusing. The same thing was true with private markets.
Yep.
And I was like, it's going to happen. I've seen the movie, to your earlier comment, it's going to happen. And there is no leader right there. There's nobody in the space. And part of it is, to be successful at Yieldstreet, we have to do two things. One is we have to educate why private markets, and then we have to educate why Yieldstreet. So the first is, why does private markets make sense for you in building a truly diversified portfolio? And why Yieldstreet? Why do we have the right to earn your loyalty and trust, right, as a client and a customer of our firm? And so ultimately, as I think about that, I knew that was going to happen. I could feel it. And that was why we leaned in. And I remain more confident today as you and I just went through a raise where we successfully raised like $77 million for this place.
Yep.
And I will tell you, one of the most encouraging things that happened in the journey of the raise was almost everybody we met with would say, don't spend 5 minutes on market sizing. Like, we get it. We're already
no longer educating on private markets.
You do not educate. We already have a thesis, and we may be debating advised versus D2C, but ultimately we think both win. So don't spend time there. Educate us on why Yieldstreet. What's the technology? What's the customer experience and journey? What's the product set like? All that stuff. And then get into the nitty gritty of the financials and everything else. And so I see that evolving. And ultimately, you and I are living this even on the manufacturing side of private market assets. Every brand name asset manager is building for retail today.
They want to reach this market. Yeah.
100%. You invested maybe 8 years ago. I invested 5 years ago. When I invested, there might have been 30 or 40 interval funds in private markets area. Today, there are 500 of them.
It is pretty amazing. So would you say, so we get into too much nuance because we know too much about this in some ways for the audience to go,
Exactly.
what are you guys talking about? But we did have to, do you believe, so Yieldstreet, for lack of a better way to put it for the audience, we were both a manufacturer and a distributor. Keep it simple.
100%.
And it's funny when I always thought when I first entered financial services, why do they keep calling themselves manufacturers? I grew up in the Midwest. We're not making cars. So people have product, BlackRock has funds, right? Vanguard has funds for the audience sake. And then there's, how do I go buy them? Do I go through an advisor, like you're saying? Do I go to an app, et cetera, et cetera? And I guess the point of that little story is we, led by you, have concluded distribution is the secret sauce, the place to be,
100%.
not to be a manufacturer. 100%. And just
100%.
talk maybe just for a minute about why that is and what has to be true to make that the case, that you don't have to be end to end, if you will.
Yeah. So two things. One is, knowing you as well as I do, I think this will resonate with you. What did the internet do? For a while when you had the internet bubble, it was going to cure cancer. And ultimately, it was the answer to everything. What did people really realize it became? One of the most effective low-cost distribution mediums out there.
Yes.
And so what did it do? It moved the power from the hands of the manufacturer honestly into the end consumer. Because all of a sudden, if you're a consumer, forget financial services, any product you want, any service you want, anything, in a nanosecond, you could learn about it and become an educated consumer. And so you could begin to demand the value for that product that was relevant to you. And that was the thing that sort of transformed, in my opinion, the whole ecosystem. And so the closer you get to the consumer, I think the more valuable the franchise. And so for me, distribution is really, really powerful, because if the consumer wants it and they're going to be educated looking for value, and the manufacturer needs to sell it to make money, and you're the toll taker in the middle as the distribution platform, I think you have a more sustainable long-term franchise.
One would argue that what you just described about the internet with a capital I is the same thing as now the capital A, capital I, which we didn't spend a lot of time or no time on AI, but it's just doing in some ways what the internet, the internet was phase one, AI is phase two of this sort of
100%.
Making everybody 100%. Superhuman, literally.
That's right. Literally, right? So if before what happened was you had the power in the hands of the consumer because of the internet, and it just made you a better, more educated, now it's going to make you a more powerful tool work source, right? So everybody in the ecosystem, things that took you a week to do, a complicated model, whereas my son says when he was an analyst at Evercore, he slept under his desk and had 2 hours of sleep because he was up all night building models. You're going to have technology in the form of AI doing it for you in 3 hours.
It already is, to your point. Yeah.
It is.
It's crazy.
It is. Honestly, I have AI SWAT teams now scheduled to come into Yieldstreet to look at every part of our business and every single one of our work streams to say what can be disintermediated through the use of AI.
And that is that's an entire podcast. But the point is, if you're not already doing at least that, you're falling behind where we are.
100. If you close your eyes, you are going to be left behind, man. So
what I'd love to do is, because you've been a startup entrepreneur, took a company public, then ran a large scale public financial service company, running a family office, running a company and a family office, your time in the boardroom with good, bad, and in between in terms of both what boards do, what good board members do, what bad board members do. Again, this audience is entrepreneurs, this audience is board members, this audience is investors. What are your couple of do's, don'ts, what you've seen as the, good, effective board member, but also board director group and not?
Yeah, a great question. So let's divide it, because I think there is a different modus operandi for public company boards than private company boards. And you see that from your own experience, right? And one of the joys about private company boards is that by and large, the board representation are people who are investors who have significant ownership. So, one of the challenges I think you and I both very much believe in is, how do you get management to think like an owner and not like just an operator, right? And so every dollar of capital is precious, and they would hold it as close as they would if they were their own dollars, right? But when you have board members who think like that, I think there's a glue that begins to hold you together. And as long as everyone's aligned about the mission and the journey that you're on, the rest of it is about tactical execution and proving it out. Okay.
Yep.
When you get into a public company setting, it gets slightly different because no one's really an owner anymore, and you're really acting on behalf of public shareholders. And I think there's room to improve that whole experience, honestly, in the board setting.
Agree.
But one of the things I've learned, and I'm going to start even implementing it, you've seen it as we've changed it at Yieldstreet. And I used to say this all the time at Telebanc and at E-Trade, and even at Jeff Nat as a private company. I've embedded this in our family office, and I do something called a QBR, a quarterly business review. Because what people forget is you have a day job running a big firm with a lot of dollars invested in a lot of companies. And so your mind is constantly focused on 20 different things, and you have to box them at each moment in time. Okay. There's either an opportunity or problem here. I'm going to take it out, think about it, solve, put it back, move to the next thing. So any job of a leader of a company, now I'm sitting in this temporary seat at Yieldstreet, is to bring back the basics at each board meeting, because what happens is people sometimes haven't jumped in since the last board meeting, which was a quarter ago.
Right.
And so in the QBR, I used to spend a couple slides in the beginning, level setting, just for everybody, reminding everybody exactly what we were trying to accomplish and where we were on that journey, and then getting into the tactics of the quarter. And I think that's super helpful because you'll get the most out of your board if you engage them in a way in which you're reminding them, level setting, and then saying, this is really what we need. How can you help me?
There's a CEO who once said, and you're describing it very well, that has been on the podcast, is really helpful. He termed this, sort of board amnesia.
Exactly.
And so you're sort of saying, is it 5 minutes? Is it 10? Is it 15? You tell me, and get everybody at the same, it's almost like now I'll use a Netflix, someone's on season 2 and someone else is back here hadn't turned it on yet.
100%. I mean, you're exactly right, because it's like some people like you live this with me. So I'm texting you. We're like constantly in the know. So, but it's true that there are other board members who are nowhere near as in the know. And so assuming that they have that knowledge isn't fair. And so is it maybe a little boring for you for the first few minutes because you know all this stuff? Absolutely. But I think it creates a level setting where then everybody can dig in and try to be as collaborative as possible in helping solve what needs to get solved for the business.
So your sort of tool here, takeaway is 10 minutes plus or minus, a couple of slides, get everybody on the same page of what we set out to do either this year or last quarter, plus maybe a quarter, somewhat time boxed, as you said, but get everybody on the same page before you just jump in.
100%.
I think you're right. It's interesting. Yeah.
And the other thing I did was I created a basically template so that every board meeting followed the same protocol. So what I was doing was putting updated information, because as a board member, you, me, we've all been there, where you get frustrated because it's like, okay, you're showing me numbers in a new way that I don't understand from last time. I'm like, where's the continuity?
Give me some consistency. Right.
Exactly. Where's goddamn continuity so that I have some perspective on whether we're succeeding or failing, right? And it's not your commentary. I want to show me the numbers, right? And ultimately creating documentation and a process and a protocol that does that, I think begins to get the board to feel like they understand, they're leaning in, the wool's not getting pulled over their eyes. They see it all in black and white. It will very much focus on the things that you have to talk about that need decision making, and you can get then into that and work your way through it.
Well, you sort of didn't say this, but I'll say the other side of the coin. When the numbers, the way they're being presented, the goalposts, to use the football analogy, start to move, credibility starts to go, and it takes about 2 board meetings before everyone's like, all right. By the 3rd board meeting, you don't believe a damn thing you say.
But damn, 100%, right? And the other thing is, listen, you have to school leaders into, by and large, as a board member and with all fellow board members on all the boards I sit, I think they just care about the success of the business. They really, really want to see the business succeed. Yep. They've invested, even if they're frustrated. So even if you have to go in and have a hard conversation that says, I know you thought this year was going to look like X, but the reality for the following 6 reasons is going to look like what? I need to be 100% transparent about you, and I'm going to set goals that are achievable, because if I don't, not only are you pissed at me as board members, but everybody who works at the organization is pissed because they're constantly missing goals. They feel demoralized. They don't understand how that connects to a bonus pool. And it's about being honest and realistic about where you are, hitting reasonable goals. I mean, as a public company CEO, what I advise people all the time is under promise and over deliver, over and over and over again. And you will end up with the support and the deep bench strength of public market investors who want to invest behind you and stay with you even when there's
it's another, right? But it's another mistake that it just is like, and I say that as an investor, like, we want to get bought into the hype. We feed the entrepreneur or the CEO beast to say, hype me. And yet we always know, look at the companies that are killing it in the public markets. It's beat and raise. It's not just beat. If you don't beat and raise, your stock actually doesn't perform. And this lesson's this is decades in the know. Yeah, we keep.
And we should absolutely be absorbing that, because it ultimately builds a culture. And so if you end up exiting that business by going public rather than selling, the culture is inculcated in a way in which people understand it's beat and raise, beat and raise, beat and raise.
For better or worse.
It's really good. And honestly, it's easier for me because A, I'm old, B, I've done this a lot. Even with Yieldstreet now, it's an interim period while we'll figure it out and then find the right CEO candidate, man or woman, to sit in that role. But no matter how pissed off the board got at me, I would be willing to take it by saying, these are realistic goals. This is what we can sign up for. And I'd rather tell you this and raise it next year, halfway through the year, than constantly be explaining why it's like humiliating. I mean, one of the things I did at E-Trade was, until the financial crisis hit and all chaos, whatever, every quarter that I was a CEO, we beat and raised. We constantly improved our revenue, constantly, record revenues, record earnings, whatever, quarter after quarter after quarter. And people believe that, and they trust you. Right.
So, the old adage, good news can travel fast, but bad news has to travel faster. And I don't want to end on a negative with the bad news traveling faster. So here's my final question, kind of brings us to a wrap. And I like to ask everybody this, so do not take this as we just have made jokes about both of us being around this business and industry a long time. But if I knew then what I know now, boy, I can't speak. When I was in my very second startup was in the magazine business. We had this When I Was 25 was the column. And you have these 50 and 60-year-olds ghostwriting a 2-page article. So the when I was 25 question to Mitch Caplan, maybe it's a couple things, but
one thing. The best piece of advice I got in my career early on was from a board member at Telebanc. And to say that he was basically certifiably insane might have been an understatement. Okay. We hired him along the way when we were going through a bit of a regulatory snafu and trying to get them to buy off on being a branchless bank. Right. And he was a bulldog. And he was a lawyer, sole practitioner, just really a bulldog. And, as I like to say, a gun-toting alcoholic. I kid you not. But one day he looked at me and he said, "You look a little stressed. How can I help?" And I was sort of describing some stuff. And he looked at me and he said, "Slim, you're never wrong. You're just late."
You have shared that one.
Right? I have with you, right? I know I have, because that's how much it stuck with me. And he's right. Like, how many times, even as board members, had you and I known something? It's like, but we just sat here trying to navigate a little left, navigate a little right, do whatever we needed to do, when in fact we should just hit the damn thing head on, right? And because generally speaking, particularly as you start to feel more comfortable in your role, whether it's a board member or whether it's a CEO or a CFO, whatever role it is, you've lived it, you're experiencing it, you're closer to it than almost anybody. Your intuition is 99% right. And by not just doing it, at best, it's stagnating, and at worst, it's harming.
It's the problem or the challenge is going to get worse, not better, because of that time you've let it go.
Haven't we lived it, right?
Yes.
So yes, 100%.
You're never wrong.
That is
You're just late.
Advice.
That may be the title of this podcast when we actually put it out there in the world to see. But what a pleasure, Mitch. And I know it sounds patronizing, but this guy right here, for the audience that's still listening with us, is really rolled up his sleeves. And a lot of board members talk a good game, but when the shit hits the fan, a burning building, they don't run into it, they run out of it. And Mitch and his team ran into it. And I couldn't be more happy to appreciate, there's so many ways to say thank you, but truly thank you for being on the podcast. Thank you for what you've done and you're doing at Yieldstreet. But I know there's a lot of great lessons in here, and I'm sure our audience is going to appreciate it. So thank you so much.
My pleasure. Always for you.
Awesome. Have a good day, Mitch.
You too. Bye.
Thank you for joining this episode of Electrifying Growth. A special thanks to this week's guest for sharing their time and insight. For more resources, inspiration, and a look inside the Edison Partners Network, sign up for our newsletter at www.edisonpartners.com. Click on the Stay in the Know button in the top right corner of our webpage. Thank you again.